Hey, it's Eric with the Future Mill. Lions and tigers and bears, oh my. It's not quite the Wizard of Oz, but you have heard of bear markets in the news recently, and you've also heard of market corrections. Well, what the heck is that? There's a lot of financial jargon that's being thrown around. So I want to take some time, explain that to you, but then also explain to you historically how long has it taken for a market correction to recover and also a bear market. So let's do this. With all of the financial jargon being thrown around in the news right now, let's talk about it. What in the world is a market correction? Well, a market correction is any time an index such as the S&P 500, Dow, NASDAQ, things like that, anytime it goes down 10%. Now, once it hits 10% and it goes all the way to 20%, it's considered a market correction. Once it goes down 20% or more, that's when it's considered a bear market. We have not seen a bear market since 2008, though we saw a market correction just recently at the end of 2018. So I want to show you some charts, talk to you a little bit more about this, because what I want to do is make sure that you understand what it looks like with a market correction, how long it actually oftentimes takes to recover, and then the same for a bear market. So check out this chart. This chart on CNBC.com talks about bear market and market corrections since World War II. We're talking 1946, and this is referring to the S&P 500. So what happened here was in February of 1946, up until February of 1946, the market fell 10%. So that was in 1 month there. The length that it happened, it shows here in the chart, was 1 month. It took 1 month to recover. Then we go to May 1946 to February 1948. The market went down 28%. So remember what I'm talking about here. With a market correction between 10 and 20%, it's considered a market correction. That's where it starts. If it leads into a bear market, then that is anything over 20%. So from May of 1946 to February of 1948, the market went down 28%. That's considered a bear market. It took 21 months for it to actually go all the way to the bottom. Once it hit the bottom, then it took 28 months for it to recover, so just over 2 years. Now we're going to keep looking at this, and I'm scrolling this chart here just to show you how many different times there was a market correction or a bear market since World War II. To be exact, based on this chart, there were 37 market corrections and 12 bear markets. So it started at the 10% drop, that was the market correction, down to the 20, and then 12 of those times it went beyond the 20%. So if we're looking at the bottom of this chart, let's look at the bear markets here. The average bear market was down 30.4%. This happened over a 13-month period of time. So over 13 months, on average, when a bear market happened, the market fell 30.4%. It took 21.9 months to recover. So that is just under 2 years for the total stock market to recover and get back to where it was before the bear market. Now, when it comes to corrections, the average correction was 13.2%, and then it took 4 months for that correction to happen. So if you're talking, we'll just say we're at a baseline of 0, all the way down to the 13.2% average, it took 4 months to get there. Then when it came to recovery, it actually happened in 3.7 months on average. So it took longer to get there to the market correction than it actually took to recover on average for this. Now I want to take you to another chart from Charles Schwab that shows from 1974 to 2018. So if you're looking here, these are all the different market corrections during this time. There were 22 total, it says, from 1974 till 2018. But only 4 of them actually turned into a bear market, where the market was down more than 20%. Looking at another Charles Schwab resource, this shows you bear markets versus bull markets. And what I want to show you with this is that if you're looking historically since 1966 till 2018, we had a lot longer of bull runs than we did bear markets. Now, when I'm talking about bear markets, bull runs, all these things, remember the bear market, 20% or more down. A bull market is any time that it is positive. So anytime we're on a positive run, that's considered a bull market. So looking at this right here in 1966, you had 240 days of the market where it went down 22% total. Then it was up 48% for 784 days, down 36% for 543, up 961. You see the pattern here. And then if you're looking all the way out from 1990 till about 2002, we had a long run, 4,494 days of bull market. And then again, coming over here from 2010 roughly till 2018. Again, 3,949 days of bull market. So there will be times where we're going to have to see a bear market. It historically happens. It is just a pattern of the stock market. The biggest thing that you can do is just make sure you aren't panicking. I say that because your portfolio should be built with enough stocks and bonds to ride the waves. If the market's down and you are needing money, it's a good idea to take from the bonds instead of the stocks, because what do you want to do? You want to buy low, sell high. Well, if the stocks are down and they're low, you don't want to sell them, so you can look at leaning on your bonds for that period. Now, this is general advice. It is not individualized advice. Your situation might be totally different. I encourage you to go to thefuturemill.com, click Get Started, book a call. We'll be happy to talk you through it and make sure we are giving you the right advice for you. Because if you are retired, you may have a lot more bonds in your portfolio and you may be leaning on those during retirement. But if you are a young professional, this is a great opportunity to buy. Anytime the market is down and you have an opportunity to buy in, that's where you're buying low, so then you can sell high. It's all about just what people talk about through the years: buy low, sell high. So be sure not to panic with the market correction and the bear market talk in the news. Instead, stick to a financial plan. Make sure you have one of those. Make sure your portfolio is aligned for your risk tolerance. And if you have any questions, remember, reach out.